Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Navigating Bond Credit Ratings, Essential Insights for Investors. Ever wonder why bond credit ratings matter so much? They're not just letters thrown around by financial experts. These ratings act as a trust score, helping investors gauge the risk before diving into bond investments. In this video, we'll break down the essentials of bond credit ratings. You'll see why they're a critical part of any savvy investor's toolkit. We'll explore what bond ratings mean, who determines them, and how they can impact your investment decisions. Whether you're a beginner or have some experience under your belt, understanding bond credit ratings will give you an edge in navigating the bond market. Understanding bond credit ratings. Navigating the bond market can feel like decoding a complex puzzle. Bond credit ratings help simplify this by providing a snapshot of a bond's risk. Let's explore what these ratings are and why they matter so much. Definition of bond credit ratings. Bond credit ratings are like report cards for bonds. They offer insight into the creditworthiness of a bond issuer and the likelihood of default. These ratings are given by credit rating agencies such as Moody's, Standard & Poor's, S&P, Fitch Ratings. Each agency uses a unique scale, but generally, ratings range from high grade, indicating low risk, to junk, indicating high risk. For example, S&P's ratings range from AAA, excellent, to D, in default. This helps investors understand the risk associated with bond investments at a glance. Purpose of bond credit ratings. So, why are these ratings such a big deal? Here's why they play a crucial role in the financial ecosystem. Investors. Ratings help investors decide which bonds to buy. They reflect the potential risk and return, enabling informed choices. Imagine you're about to buy a used car. A high rating would be like knowing it has low mileage and a spotless maintenance record. Issuers. Companies issuing bonds want high ratings. A better rating means they can attract more buyers and secure lower interest rates. It's like a seal of approval that says, "Trust us, we're reliable." Market stability. For the market as a whole, consistent and transparent ratings promote stability. Clear risk assessments prevent panic and help maintain confidence among investors. Think of bond credit ratings as a compass, guiding both seasoned experts and newcomers through the vast financial sea. They ensure that everyone is on the same page regarding risk, making the market a safer place for all. How bond credit ratings are assigned. So, how exactly do bond credit ratings come to life? They don't just appear out of thin air. These ratings are crafted through a careful process involving key players and meticulous analysis. Credit rating agencies evaluate a host of factors to provide these vital financial insights. Role of credit rating agencies. When it comes to credit ratings, 3 big names stand out: Moody's, Standard & Poor's, S&P, and Fitch Ratings. These agencies act as the gatekeepers of the bond rating industry. Moody's kick-started the whole ratings game in the early 1900s. It's known for its rigorous approach and detailed reports. Standard & Poor's, often cited as S&P, is another heavyweight. It's renowned for its comprehensive evaluation standards and a diverse range of services that extend beyond bond ratings. Fitch Ratings might be the smallest of the 3, but it still packs a punch. Fitch is recognized for its dual-path approach, combining quantitative models with qualitative insights. These agencies assess bonds, assigning ratings that communicate risk levels in a way that makes sense for investors globally. Methodology for rating bonds. Ever wonder what goes into determining a bond's rating? It's not just about crunching numbers. Agencies consider several factors to ensure accurate ratings. Financial health. This involves analyzing the issuer's balance sheet, profit and loss statements, and cash flow. The focus here is on liquidity, profitability, and financial stability. Economic conditions. The broader economic environment can significantly impact bond ratings. Agencies look at interest rates, inflation, and economic cycles, which may affect the issuer's ability to meet its debt obligations. Issuer specifics. This entails a deep dive into the specific bond issuer. The agency examines the issuer's management quality, strategic positioning, and competitive advantages. For government bonds, political risk may also play a role. Think of bond ratings as a financial fitness check. It's like a health report for a company's fiscal state and its resilience against external pressures. The result? A letter grade that serves as a quick guide for investors weighing the pros and cons of potential investments. This process might seem complex, but it's essential for providing the transparency and trust the bond market thrives on. Types of bond credit ratings. Understanding the types of bond credit ratings is crucial for any investor looking to make informed decisions. These ratings are divided into two main categories: investment grade and non-investment grade. Each category comes with distinct features and implications for investors. Investment grade ratings. Investment grade ratings are like the gold seal of approval for bonds. They offer a sense of security, indicating that the issuer is financially stable and has a low risk of default. These ratings, typically ranging from AAA to BBB on S&P's and Fitch's scale, or AAA to Ba3 on Moody's scale, represent bonds issued by governments or corporations with solid financial standing. Why do these ratings matter? Investment-grade bonds are favored by conservative investors looking for steady income without much risk. They are seen as a safe harbor for capital. When you invest in such bonds, you're essentially betting on the issuer's ability to honor its debt obligations. Here's why these ratings are important. Lower risk. These bonds have a lower probability of default, meaning your investment is more secure. Stable returns. With less risk comes more predictable returns, making them ideal for risk-averse portfolios. Market confidence. High ratings foster trust and confidence in the market. So, if you're after security and reliability, investment-grade bonds are your go-to choice. Non-investment grade ratings. Non-investment grade ratings, often dubbed as junk bonds, tell a different story. These bonds have ratings below BBB, or Ba3, and carry a higher risk of default. But with higher risk comes the allure of higher returns. Investing in these bonds is like riding a roller coaster, thrilling but not for the faint of heart. They can offer juicy yields, but there's always the risk that the issuer might not be able to make good on its promises. Here's what you need to consider. Higher risk. The chance of default is greater, which could mean losses for investors. Potential for high returns. These bonds offer higher interest rates to compensate for the increased risk, appealing to investors with a taste for adventure. Volatility. The value of these bonds can fluctuate wildly, influenced by market conditions and issuer performance. Non-investment grade bonds can be enticing, especially in a low-interest environment. However, they demand careful analysis and a strong stomach for risk. In the world of bonds, balancing risk and reward is key. Investment grade and non-investment grade ratings guide investors in navigating these waters, each offering unique opportunities and challenges. As an investor, understanding these ratings helps you make decisions that align with your financial goals and risk tolerance. Importance of bond credit ratings for investors. When it comes to bond investing, credit ratings serve as your guide. They're more than just grades. They offer a window into a bond's reliability and the potential for returns. For investors, understanding these ratings is key to making informed decisions. In this section, we'll explore how bond ratings affect your investment strategy, focusing on risk-return profiles and how they influence market dynamics. Evaluating risk and return. Bond ratings are pivotal in assessing the risk-return equation. They help investors gauge how much risk they're taking on, which directly impacts expected returns. Think of a bond rating like a risk thermometer. A high rating signifies low risk, while a lower rating indicates potential danger but with the possibility of higher returns. High-grade bonds, AAA to BBB. These bonds usually offer lower yields but come with the assurance of minimal default risk. They're ideal for investors looking for stability and safety, akin to keeping money in a well-secured vault. Non-investment grade bonds, below BBB, known as high-yield or junk bonds, these present higher risk and the lure of greater returns. It's like betting on a horse race. The stakes are higher, but so is the potential payout. Understanding a bond's rating helps you align your investments with your risk appetite. It's all about striking the right balance between safety and growth potential. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.